Welcome to another live stream. Here is the truth. The market doesn't care how hard you try. The market is just doing one rally after the next crash. We see fake out after fake out, and people try to figure out what's the reason here. Why do we see things going down all the time? Why is everything crashing all the time? Now, people try to get explanations, but unfortunately, those kind of explanations are very often not so right. For example, this was the story last week, right? Jane Street manipulating the Bitcoin price, Jane Street dumping the Bitcoin price all the time at 10 o'clock. This was published by Andre Jig. Here's another video published by Tom Bilyeu, not sure how to probably pronounce the name, but everybody talked about Jane Street first. This is the reason why Bitcoin is going down. That's the reason why we can't see new rallies. But really, very often those kinds of manipulations only happen on the short time frame. So what might have happened here is that Jane Street simply didn't adjust the holdings versus its future positions directly one-on-one every second, but maybe did this adjustment only once a day. And maybe it did this intentionally to create some volatility and maybe to create some liquidations. But really, the average spot holder is not getting impacted by this at all. Who gets impacted by that manipulation? It's the people that have highly levered positions on Bitcoin, that go 20, 30, 40x Bitcoin, and where then maybe a 2 or 3% drop can have an impact. But then afterwards, right, just a few minutes afterwards, Bitcoin recovered again. So Jane Street simply balanced out the position. So really, the spot holders didn't get impacted by this. It was just the short-term futures traders where then Jane Street was able to extract some value out of that. And so people try to blame, right? People try to figure out what is the reason for the long-term downtrend. Jane Street was, of course, one story. There is another, maybe a bit more fundamental story, which is the war in Iran. But here's the thing, right? The question is always, is it the news that drives the price, or is just the price movement in line with the news? So one might expect, right, when there's now this huge war going on, where Iran is attacking everybody, after it gets, of course, attacked by the US and by Israel, that because of this potentially growing conflict, that the market should be quite spooked, that there might be an impending World War III, and because of this, everything should be going down. But is that truly what is going on? Have a look at Bitcoin's price. This is what Bitcoin did once we got clarity around the attack. After the price went down by 3.6%, it very quickly recovered. It even overshot in its recovery. And since the declaration, since the attacks, the price pretty much moved not at all. So there was no price movement whatsoever. And I'd expect that once traditional finance opens, again, we won't see too much of a change. So really, it's always a fundamental philosophical question almost. Should we try to trade the news? Should we try to anticipate how news developments, macro developments, change markets, or should we rather work based on psychology? So do we try to figure out where is now the Iran war headed, or should we just work with our general approaches? And I rather tend to think that the second approach, having some kind of structured rule around trading, makes more sense than trying to anticipate where politics are going. Because yes, short term they can have an impact. Yes, Bitcoin did go down 3.6%, but as long as you're not an insider in the market, does it really make sense to try the market based on that information? There's many drivers in the market. There's many things that move prices. Why shouldn't we use the drivers for our trading that we can actually control, where we can actually have some kind of insight what's going on? If I was to show you this chart here, right, the chart of Bitcoin over the last month roughly, and I was to ask you at what point in time can we see where was the declaration of war, or where was the attack published, you'd have no idea, right? It's not clear at all where Jane Street manipulated or where the war started, because it's all just noise. In the end, news articles and the trend of the day, the attention of the day, it simply just fluctuates. It simply just changes. And it's too inconsistent in order to use a proper trading strategy based on that, unless you're of course an insider. If you're not an insider, just ignore that noise. That's the big problem. Most people try to trade just based on noise. And so that's our first little introduction to this live stream. Thanks again for joining in. I've got a few comments here directly on the screen. Feel free, of course, to give this a thumbs up, first of all, right, to help this channel grow, to help the live stream spread, that more people can tune in. And I very much appreciate all your comments, even if it's just a hello from wherever you're currently from. I'm in Malaysia, so it's very early here. It's 4:30 a.m. But I like to make those streams early in the morning. I go to bed early, I wake up early, and I want to be available for you guys, for everybody in the US, for everybody in Europe. And yeah, the people in Australia and in Asia probably will not tune in, but still. The vast majority of people here, they are now awake. And so I'm very happy to make that live stream at hopefully the best time for most. So yeah, thanks again for everybody tuning in. Let's get into some comments. Is Pepe heading for a rug pull? Yeah, I made a video on Pepe just recently. The issue with Pepe is the supply is very much concentrated in just a few holders' hands. Thus, the circulating supply that's currently being traded, that's in the liquidity pools, is very narrow. That means many people that see a rising price of a random meme coin in a market like this are very skeptical, and they bet on falling prices. And what we then see is market manipulation. We see how the market makers, they buy up more of the Pepe supply and then short squeeze everybody. And so that's the whole idea what's going on here, right? It's simply just a game of market makers versus retail investors. Of course, the market makers can't manipulate a price forever. They can't push it up to like hundreds of billions of dollars in market cap. At some point, short squeezes do turn around, but the market makers tend to have deeper pockets than the average retail investor. And so it's very hard to play this game directly versus the market maker. Fundamentally, how I think about situations like this is, I want to make money versus people that are not that experienced. That's one of the reasons why I am in crypto and why I don't trade, say, the currency market. In the currency market, there is the quants, there is the very experienced people with decades of knowledge, with decades of experience. The competition is very hard. And if I want to make money above just the average investor, if I trade actively, I need to time the bottoms and the tops better. I need to know more than the average market participant. I need to be more skilled than the average market participant. And if the average market participant is a big institution with math PhDs, that's my competition, then I've got no chance. But if the competition is just an average retail investor, it's easier to win. And so when we look at something like Pepe now, the question is the competition weak enough to time the bottoms and the tops better? And I don't think so. The issue really is that this is then a game against the market makers. We are then trading directly against the market makers. And I don't want to have the market makers as my competition. I rather want to have the average retail investor as my competition. And so I simply don't touch those short squeezes unless the market cap is so high that it will become very expensive for the market makers. When the market cap of an asset like Pepe reaches $3, $4, $5, maybe even $6 billion, at that point I'm okay to take a bet against this, because it's very unlikely that we hit 20 billion or 30 or 40 billion in market cap for an asset like this. So that's the thing that I'm always thinking about. I try to not necessarily bet against the market makers unless the situation becomes extreme, which currently is not the case. Pepe is at roughly 1 billion market cap right now. But yeah, thanks for the question, and feel free to keep the questions coming because I want to answer as much as possible. We of course also have a lot of charts that we're going to look at for the general macro. We will hit the lows this month, March 28th. Yeah, not sure where this is coming from. I expect the bear market to continue for a bit longer, but nobody can know this for sure. So if there's ambiguity, if you're currently under allocated, it always makes sense to at least buy a little bit and then allocate towards the market. But I'm currently simply trading according to the best moving averages. With that topic, actually, let's have a look at this. This is Bitcoin. This is Bitcoin with the best moving averages, right? So the 44-day simple moving average, that's the line in orange, and the 125-day simple moving average. Why do we have two moving averages here? We've got two moving averages because they react for different time zones. for different time frames rather. And the 44-day moving average is better if you were to trade Bitcoin with leverage. If you want to go multiple X long and potentially multiple X short, if you want to bet on falling prices as well. If you only trade Bitcoin based on the spot market and you sell it and you buy it and you've got higher transaction fees and you don't want to make so many transactions and incur all those fees, then the 125-day simple moving average is better. So whenever we are above, we should be betting on rising prices, or we should buy Bitcoin. Whenever we are below, we should be selling, or we should be betting on falling prices. Currently, we are still below both moving averages, and interestingly enough, all of this talk around Jane Street and the war, etc., it all just happened in this little sideways trading range with slight movement down. So really, the news, they bring a lot of entertainment, potentially, if you can call a board declaration entertainment, but they don't really move prices much. And that's really what we care about when it comes to trading. We want to see the things that impact prices. And I think what impacts the price most for Bitcoin is simply the general psychological state of the market. If we have always topped out after roughly 3 years of a bull market, and then we saw roughly 1 year of a bear market, and we've got a 4-year cycle that tends to reinforce itself all the time, and it probably makes sense to at least take this into consideration. It probably makes sense to take the best moving averages into consideration. This here is the backtest of the 44-day SMA, right? So that's the line in orange. If we just follow that line and we bet on falling prices whenever we are below, and we bet on rising prices whenever we are above, that's the kind of outperformance we can get versus just buying and holding Bitcoin. This is a chart that starts in 2015. And yeah, this is a logarithmic scale. Each of those horizontal lines, that's a 10x difference. So the difference is massive. Here's the same leverage optimization. So when we look at how much can we go long versus how much should we go short in terms of leverage, the x-axis is the amount of leverage, the y-axis is the annualized performance. We can see we can go much more long in terms of leverage. We can go up to 2.75x. That's the optimum. And for short, we have to be a bit more conservative. The best short is at 1x, the best short leverage. If you just take the same leverage for both sides, that's the black line, then somewhere between 2 and 2.25x is the ideal. For our copy trading vault, we don't use 2.75x for long. We only use 2.25x just in order to reduce the volatility of our performance. So we want to have the best risk to reward. This here is the best reward, but it's not necessarily the best risk. The drawdowns are quite high when you use 2.75x. But what I find very good about this chart, and this is what many people don't really understand, is we really do not need too much leverage. Now this is just leverage relative to our portfolio, right? So our trading portfolio. So let's say we've got a 2x leverage. Our trading portfolio is say 100K. We should have a position size of 200K. This is not depending on what position we've actually opened, right? If you only open, say, a 10K position and we want to have a 2x leverage on our portfolio, we can actually set 20x on that 10K, as long as we've got cross margin enabled, etc. But those are kinds of details that I explain later in premium, if you're interested in that. In general, make sure that you don't take too much leverage relative to your portfolio. Don't have a trading portfolio of 100K and then put a 20x leverage on this. You're really just waiting to get liquidated. 3x is the absolute maximum, and it's probably not even ideal. It's better to just keep it at around 2x maximum. I know it feels like we always don't have, it feels like we leave gains on the table. But it's really not the case, because every now and then we get those flash crashes and you don't want to get wiped out in those flash crashes. The best risk-adjusted leverages usually is at around 2x. And if you use altcoins, they tend to be even more volatile. You might even go lower than that. That's what the numbers say, and I just trust in numbers. So, yeah. Let's have a look at a few more questions. Again, please feel free to keep the questions running, and feel free to also, if you haven't yet, right, if you've just joined, give this a like. I almost bought some Bitcoin this morning. Ah, wait, I want to do something. I've got a little voice changer here to make it a bit entertaining and to also differentiate when I'm talking versus when you guys are talking. So I can change something here. So let's see if that works. Macro operator XBT says,
I almost bought some Bitcoin this morning, but I got an emergency at work. Viva emergency.
Yeah, so in general, right, if you've got a longer time horizon and you just dollar cost average anyway during crashes, the short term doesn't matter too much. If you trade actively, then even if you get these little crashes, it's fine because the next opportunity comes anyways, right? So it's like the worst thing that can be done is always to try to chase the market. There are some interesting videos about this, but when people say, oh, the price might be coming down, it's falling, and then out of panic they are selling, then it's recovering, they think, okay, it's coming back up, and then they're buying, and then it crashes again. Trying to chase the market is always the worst. So it's better to always do the opposite of what the masses are doing, at least in the short term. In the medium term, it's better to follow the trends. That's why we use the moving averages. And over the very long term, it still makes sense to do the opposite, at least during bear markets, right? If we crash heavily from the all-time high by 60, 70, 80%, it makes sense to be contrarian. But yeah, so it very much depends on the time horizon. Very long term, contrarian in the bear case. Medium term, going with the trend, and very short term, it does make sense to be contrarian in both directions. If we rally very, very quickly, it might make sense to take some profit, not all, right? Always just partial profits. And if we crash very quickly, it also makes sense to adjust a little bit the position and buy a bit. So it always depends on time horizon. What do I mean by with short term, medium term, long term? Short term means when you look at, say, the hourly charts. So your time horizon is maybe 1 to 2 days. Medium term is several days, several weeks, potentially several months. And long term is when you have a year time horizon, right? When you look at, I buy now and I'm okay to hold for, say, 2 or 3 years. But yeah, thank you, macro operator. And I've got a few more of those voices here. So this is the device. It's a Stream Deck. And I can change to all kinds of funny voices. Because I thought, you know, if there's not much happening anyways, in crypto at least, why not use different voices, right? Like
this, for example. Or here's
a radio voice, right? If this is not worth a like, I don't know what is.
Yeah, this is another voice. I will use those different voices.
I will use those different voices across the stream. So yeah, hope you will feel entertained. Low 40s, that's probably referring to the Bitcoin price target, how low we could go in the market. I agree with that. 40s are definitely possible, even low 40s. Default 812 asks the following.
This is decided first, then the news is added. For instance, is it interesting? Why? A lot of Trump tweets are out of market hours. Liquidity is available in crypto and in tokenized gold.
Yeah, that's how I work with the market in general. I think it does make sense to just look at the market structure, where is liquidity, where is attention headed, and not worry too much about news developments, because we can't impact the news anyways. We can't also anticipate the news better than others unless we are insiders, or unless we've got a very strong knowledge base in a particular news-driven event, right? If we know, say, geopolitics very well, and we look at the troop movements very closely, and we have analyzed troop movements in the past, and considered, hey, how often does a certain event happen? Then of course we can trade based on that. But even in that case, I'm not sure if we should trade, say, Bitcoin for that. If you want to trade political events, you can simply use Polymarket. If you don't move millions of dollars with a single bet, but you move just a few tens of thousands, maybe hundreds of thousands of dollars, you can use Polymarket for those very big political events, and you can make much more money with that, because it's just binary outcomes. You either lose or you win. And if you have insider knowledge, or if you know something much, much better than the rest, then why trade Bitcoin based on that knowledge? Why not just make the pure play? That's in general how I think about trading and using different
assets. I do not want to trade based on I don't want to have a certain thesis on something and then trade a different asset that might only benefit or react to a certain thesis on a secondary level. I want to always play the pure play, right? Let's say I want to bet on rising or falling interest rates, then I buy or short long-term treasury bonds. I'm not buying or selling, say, technology stocks. Or if I want to trade crypto, right? If I have a certain idea about, say, where the crypto market is going, I would not necessarily then start buying and selling MicroStrategy. I would rather directly buy and sell Bitcoin. I would only touch MicroStrategy if I've got a certain idea about MicroStrategy specifically.
So if I think that MicroStrategy itself is overvalued, undervalued relative to Bitcoin, I might long or short MicroStrategy relative to Bitcoin. But I would not make a positional bet on crypto by buying MicroStrategy or selling MicroStrategy. It's always better to just have the pure play, because why pollute one's performance with different impact on a particular asset if you can have the direct exposure to something. And it's the same here with news, right? We've got Polymarket now that gives a very clean exposure to particular events. If you don't have very deep insight into those events, then why trade the market based on those events? There's many other factors that move prices anyways, and we never want to be right all the time, right? We just want to be right more often than we are wrong. And so everything that we don't understand, we just judge it as noise. We just judge it as something random, even though it might not be completely random, right? Even though it might be possible to trade based on it, but we just regard it as random. And the only thing that we understand, that's then what we trade upon. And that's then the thing that we focus on and that we try to use to beat the market. Everything else we just ignore, and we can, because long-term those kinds of developments, of course, also cancel out. But yeah, interesting input. Thank you very much. Let's
go back.
So now I've got the right voice. Let's go back to the screen again. Let's have a look at a few more details. So what I like about the moving averages, right? They first of all outperform the market very well. Just buying and holding obviously is not as good as following the trend. What I also like is that it's kind of a hedge, because it follows trends. It doesn't necessarily decide on where we are headed, right? If we are below, we simply bet on falling prices. We can make quite good gains, right? So if we look at the moving average vault, the copy trading vault for the premium members, it made quite some gains, and measured in Bitcoin, it's up. So the idea is that we just want to, quote unquote, stack more Bitcoin over time and outperform the market. Really, when you look at investments in general, you want to check, are you outperforming the benchmark? Not are you making US dollar gains? If you trade, say, technology stocks, is your portfolio doing better than the Nasdaq 100? If you're trading crypto, is your portfolio doing better than Bitcoin? If you're trading precious metals, is your precious metals portfolio doing better than, say, the gold market? If you don't have those kinds of benchmarks, if you just look at the general US dollar performance, you are distorting the picture. You're not really looking at the competition. And the competition is always just passive investment in the market. If you do nothing and you just passively invest in gold, or you just passively invest in Bitcoin, and you get X return, and you look at this as a reference point, it's much better than just looking at the US dollar price. Because let's say the US dollar devalues by 50% because for whatever external event, right? Let's say a lot of new money gets printed, all assets go up by 100%, and your trading portfolio goes up by 90%, and you spend hours and hours every single day to just trade. You feel like you're the king, you made 90%, but really versus the benchmark, you even lost, and all of that time that you actively traded was for nothing. The idea really is that we want to increase our skill to a degree that the additional performance versus buying and holding is high enough that it justifies spending all of that time. So there's two components to trading. There's on the one hand the execution part, where we have to follow the changes in the market, where we have to see what's going on. But really the majority of trading time should not be the execution, where people just draw lines on charts and try to figure out what's going on right now. That should not be the majority. The majority should really be developing skills. It should be developing how to do backtests. It should be figuring out what really was driving the price. We should really figure out what kind of approaches could potentially work. What kind of platforms can we use to optimize trading fees? What kind of psychological issues do we potentially face? How can we monitor our risk properly, that in the worst case we don't lose everything if we suddenly see mispricing or flash crash, etc. It's really the skill development that gives us the long-term edge, because in the end it's both a game of luck and a game of skill. It's a mix of both of those. There is a luck component, but there's also a skill component. And the higher the skill component is, the more we outperform long term. And so in order to outperform, we shouldn't execute all the time with 0.1% alpha per year. We should rather work a lot to increase our alpha per annum and then maybe execute a bit less. So it's operations versus business development. It's executing trades versus improving skills. And really, the majority of time should just be allocated towards improving skills, improving our approaches. And that's, I think, what most people get wrong. Yeah, let's have a look at a few more comments. Hi from Melbourne. Yeah, hello, Gareth Harrison, 2756 from Malaysia.
Hi from Paris.
There you go. Hello, Beck MSK 8868.
And hello to Cape Town.
Yeah, I still have to figure out how to do this with the voices here. But yes, greetings to South Africa. I'm mainly sitting on the sidelines for now. Yeah, that's definitely a possible approach as well. Better be patient than do over trading and then end up generating too many fees. I'm shorting Solana at the moment till Asia opens. Definitely possible as well.
USA Deutschland, danke für deine Antwort auf meine Mail letztes Wochenende. Melde mich nochmal bei dir.
Yeah, okay, welcome. I don't remember what email you exactly sent, but I always try to answer emails as well. But of course, it takes some time. What's your prediction for Bitcoin? Will it go up in the next month, or will it be around current levels? I don't think that there's too much upside potential. It's always hard to say, right? I don't try to give predictions. I always think about what's the potential upside versus the potential downside. And currently, historically, right, we always fell quite a bit from the all-time high. I believe that if history is any indication, we could fall up to 72% from the all-time high, which would bring us to the 40K levels. But of course, history doesn't necessarily have to repeat itself. But that's where we potentially are headed. But I don't try to give predictions. I'm very much okay to just change my mind if momentum suddenly changes. And it might change anytime. The current support is relatively strong. So, yeah. But yeah, I publish a lot of videos on that topic as well. And we're going to talk about this as well. Will BlackRock, Fidelity, etc. accept a 50% drawdown on their colossal average purchase price of 60K? Yes, they will, because a lot of this is just owned by the retail investor, right? So this is not positions made by the companies. It's just they just created an investment vehicle, take some fees, and don't have any exposure to Bitcoin at all. This is mainly retail money. And retail tends to also just forget about Bitcoin. If an investment is in the negatives, people tend to just not look at their portfolio. They just ignore the problem. And when investments are in the positives, then suddenly people get excited about it. As long as we're in the negatives, I do expect the selling pressure rather to ease by those people that own, say, the ETFs by BlackRock. But of course, there's still selling pressure by the long-term holders that bought Bitcoin much earlier.
What do you think about the opening of the market this week? Will there be a big dump?
I don't see why there should be, right? There is some news, but the news don't drive the market as already declared in the opening. I don't think that that there should be anything that's dumping the market anytime soon.
Protocol also close to rug pull potentially, right? So it's always the same game. Those very illiquid.
Oh, potentially. I still have to get used to this. But I think it's fun. Like, let me know if I should stop this, but I think it's fun. Have to get used how to press the buttons. But yeah, in general, with these very illiquid tokens, I rather would stay away until they hit those very extreme price levels. Yeah. BlackRock has been buying almost 1 billion in Bitcoin for the last 4 years. What's your opinion on the odds being we get a pump soon because institutions tend to buy when price drops and vice versa? Again, the institutions don't necessarily have positions, and besides, say, MicroStrategy, right? And besides all the treasury companies, when we just look at the ETF purchases, I think that's mainly retail, potentially also family offices, etc. It's not that BlackRock itself buys the Bitcoin for themselves. They buy this in the name of other people. And so, yeah, it's just the regular retail flows that always make the ups and downs of the market. Let's actually talk about this a bit more. Have a look at this here. Have a look at this here. This is Ethereum's price versus its best moving average. And what's very interesting about this is the best moving average, first of all, is the 34-day simple moving average. What's interesting about this is that here with this asset, we are the closest to potentially turning bullish. We are still bearish, we are still below that moving average, but if one day we were suddenly to rally by quote-unquote just 11%, if we were to close a day at $2,150 or so, and that level is coming down day after day, then Ethereum could suddenly bounce. And when Ethereum bounces, there is a lot of impact on the altcoins as well. So that's the potential, at least short-term relief rally that we might get. We might see a better performing Ethereum price. Now, will this happen tomorrow? Will this happen the day after tomorrow? Who knows? But there's also a potential support that I think many people have actually on their radar. Because this is just the US dollar price. Many people look at US dollar prices. And interestingly enough, those bottoms tend to align relatively well and the tops align as well, right? Those are two parallel lines. It's nothing just connected. Those are parallel lines. And we might already bounce right now. We have bounced once at the current level at the end of 2022. So we could draw this double floor over here. And there is a chance that we already get above the moving average soon and that then Ethereum rallies quite a bit. There's also a chance we continue to fall and we might revisit the support. But we're getting closer and closer to potential important supports. So the likelihood of turning bullish on Ethereum increases over time. I find this interesting because the picture for Bitcoin does not look as bullish. Right? For Bitcoin, we are still quite far away from the best moving averages. And that might be a potential turnaround. Maybe Ethereum can soon outperform Bitcoin again. I'm still betting on falling prices of Ethereum personally, but I might change that rather sooner than later. And we might see at least a short-term altcoin rally again, given that we are close to a support that I believe many people watch, and given that we are also very close to the best moving average. Again, we are not hyper close to it, but among the main altcoins, among the main cryptocurrencies, right, Bitcoin, Ethereum, Solana, Ethereum has the strongest chance to turn around because of its support and because of its closeness to the moving average. We've done very well with our moving average trading vault, by the way, right? It was launched 40 days ago. And it's already up 44%. Of course, that's not sustainable, right? Annualized, that's 2,500% almost. But yeah, we are doing fine following the trends. And that's a nice thing, right? It's a nice diversifier to a portfolio. If currently you're mainly long and you don't really care about potentially hedging yourself, following trends, at least with a part of your portfolio, I think makes a lot of sense. And yeah, historically, right, Bitcoin's backtest made 115% over buying and holding. Ethereum's backtest made 210% over buying and holding. And that's what I hope for will happen going forward as well. So far, we are on track. We're even above our plan. This is Solana with its best moving average. Again, there's a bit more distance to be overcome here. That's a close to 30% rally, or even more than that. It's a 35% rally or so that we need. We need to get above $110 per SOL in order to turn bullish. So the picture is slightly different for different major cryptocurrencies. They're all, of course, bearish, but they will turn around at different points in time. So keep that in mind. Ethereum, of course, will be a very important trendsetter for the altcoin market in general as well. Okay, let's have a look at a few more questions.
Have you ever invested by taking the Lindy effect into consideration? No, I have.
No, I have not.
Good afternoon from across the pond.
Good afternoon, Dusky Doodle.
LMAO.
Wait, I actually have something better.
LMAO.
That's the minion voice. If that's not worth a like, I don't know what is. Yes. Sir, do you trade Polymarket, sir? I did toy around with it. There was a very nice trade for whether or not Satoshi will move Bitcoin. I opened that like 2 months or so before the year closed, and the odds of Satoshi moving its Bitcoin were priced at around 15% or so. And I believe that the likelihood of Satoshi moving the Bitcoin within 2 months was less than 15%. So I bought that and made some money with it. I also announced this in the premium channel. So some other members entered that bet as well. But I'm looking for things where I think I have an edge, and estimating the probability of Satoshi moving Bitcoin, I think, was relatively straightforward, right? It didn't move the Bitcoin for many, many years. Why should it do it now? And why should it do it now within 2 months? Do you think gold will skyrocket in the next couple of hours when the market opens? Please, when you've got questions like this, always put your reasoning behind this, right? Because I could say, I think gold is now overvalued. I've talked about the gold and silver market in prior videos as well. It's very expensive relative to the money supply. I do not actively trade the gold and silver market. I do have an allocation towards physical gold as an insurance. I used to trade the gold market via ETFs as well when gold was still very cheap. That has of course changed over the last 2 years. So I'm not in gold ETFs anymore. If you trade gold actively, again, you need to have an edge. You always have to think about, do you know more about the gold market than the average Joe? Do you know what the newly mined gold will be? Do you know what the demand by the central banks will be? Do you know what's driving the gold price? Are you more informed than, say, 90% of the market? If the answer is no, then just allocate towards it. Then don't try to time the market, don't try to actively trade it. Because otherwise, if you make money, it's just luck, it's not skill. And long-term performance is always the skill edge that we have. It's not luck. It's kind of like a casino, right? If you never know the outcome of a particular bet, you never know the outcome of a particular trade, but you do know that if the odds are in your favor, that long-term you will win more games than you will lose. That's of course now from the view of the casino. They will win long-term, even though they don't know where the roulette game will end in this particular instance. But they do know if they have 10,000 of those instances that in the end they will make money. And that's the same with crypto. And the more skill we have, the more we know compared to the average market participant, the better our expected value per trade gets.
Nice toy for this bad moment.
Yeah, I think so too. I think it's fun. I mean, I can't hear really what's going on when I press these buttons, but I will watch the recording. It should probably be fun. I like the voices. Thanks, Steve. Yes. Will also be interesting. Some of those moments here in the stream, they will also be then cut into individual videos, and then maybe this will be even more entertaining, right? It will be maybe a nice hook for the video. At D15 asks, is your wealth exposed to different currencies as well as different asset classes? 80% of my wealth is in a currency that is a 20% rise or fall against the euro. Isn't uncommon. No, I do not diversify across different currencies. The reason is that the volatility across currencies usually is not too high. So when you look at the US dollar versus the euro versus the Japanese yen, yes, there are some movements, but they tend to be in the 10-20% range maximum per annum. If you are in a country where you've got a very volatile currency and you need to own that currency because you use it every day, and you've got a currency that potentially also very long-term underperforms the US dollar, what I would do is I would try to estimate how much does the currency long-term devalue? What's my expected rate of devaluation? Very often what we see with those kind of currencies is also that, say, fixed deposits get paid more in interest. Right? So if you've got, say, I don't know the numbers now, but if you take, say, the Turkish lira, probably if you invest in the Turkish lira in the bank account, you will have a higher return. You will get more interest payments versus, say, the US dollar. If that's the case, then just estimate how much does the lira actually underperform year over year, and how much does the US dollar outperform. And if your interest rate that you make is higher than your expected underperformance, it might make sense to diversify a little bit with the local currency. Again, because you need to have exposure to that local currency anyways. But I don't trade the currencies actively because, again, I don't have an edge in the market. I also don't diversify in them because the volatility isn't high enough. And again, the expected value of owning a currency tends to be negative against monetary debasement, usually, right? So for the US dollar, that's even the case. The US dollar being one of the strongest currencies over the last decades, still the monetary base expanded by 6.8% per annum. Usually we didn't get that kind of return. So the real interest really is even negative for the US dollar. So I don't want to own too much fiat. And for the fiat that I do own, I just have it in the US dollar. I also don't want to overcomplicate things. There's also some value in keeping things simple. And there might be a bit of diversification benefit of not just holding US dollars, but maybe also some euros and some yen. But that diversification benefit for, say, let's say I've got 30 or 40% of my net worth in the current market in fiat because the valuations are very high, right? I want to be rather risk off. If I have now those 40% in the US dollars, or if I have 20% in US dollars and 10% in euro and 10% in yen, it probably will not move the needle that much, right? If I expect currency movements in valuation to just be, say, up to 20% per annum, and I've got 10% of my net worth in something else, I basically changed my net worth by 2 percentage points in a year. And doing all of this hassle, doing the rebalancing probably is not worth it if instead I could focus the time on timing the crypto market better, trying to find new ways to time it better, and outperforming the market that I'm actually most informed in. So that's how I think about this. But yeah, if you're okay with the overhead and if your cash position is huge, or if you are based in a country where the currency is very weak, but you've got extremely high interest payments, it might make sense to diversify in the fiat world a bit as well. But thanks for the question. This is a very nice question, actually. This is something I never talked about. That's also one of the reasons why I make those live streams, to talk about things that I haven't discussed before. Because Yeah. I'm trying to figure out what's the perfect temperature here on my aircon. It's great to have new input, to talk about new topics. David 5002 asks,
Why is Bitcoin stable even after the war in Iran? We reached the bottom.
interesting question, right? This could be a potential explanation. If the market does not react to negative news, does it mean that all pessimism has already been priced in and that we can only go up from here? That's actually quite good reasoning, because very often the markets just trade within psychological ranges, right? When we are below the realized price, for example, we tend to see less selling pressure. When we are way above the realized price, we tend to see more selling pressure. And so different news get priced into the market to different magnitudes based on where currently our valuations are. If currently valuations are already very low and we get negative news, we might see less of a drop. If currently valuations are very high and we get positive news, we might see less of an appreciation. And so this is actually sound reasoning. I simply think that maybe the war in Iran that we currently see might end relatively quickly. It doesn't seem like the government will stay in charge for long. We've already seen how the leader got killed. So maybe this will go on for a while. We don't know, right? The Iraq war also went on for a long time. This might have impact on inflation. But even if that's happening, right? Even if we see a lot of money printing, as long as the US dollar still has its demand, as long as debt to GDP doesn't rise too much, we should at least see, measured in US dollars, many assets going up. Of course, gold would appreciate most with more inflation, but valuations don't necessarily come down. The only bearish scenario we could see is when the war extends that much that suddenly global supply chains get interrupted, that maybe GPU manufacturing from Taipei, right, from Taiwan, can't get shipped anymore to the US. If there are some kind of those kind of limits and the AI stocks are coming down because global chip manufacturing is in trouble, that of course would be an issue. But I think given the development in the last 24 hours or so, I'm not a geopolitical expert, right? I'm not trading based on this. But my impression is also, given how the market has reacted, that the Iran war is probably not going to spread way beyond where it currently is at the current stage. It will probably be contained to a degree. And so all we might see is just a bit more inflation, but probably no global crisis. So we can be very lucky that that's all that's going on.
With the 44-day simple moving average strategy, would it make sense to be more aggressive with short positions since we are still in the bearish trend, maybe 2x?
No, I do not think so. I think it makes most sense to only change leverage if our macro picture has massively changed. Let's say we are below the realized price and then we go above the moving average. It might make sense to increase the leverage that way, but only also up to the level that historically worked well, right? Currently, when we go long, we go 2.25x long, but actually the best leverage is 2.75x, so 0.5x more. But we don't take the 0.75x because of the potential downside that we have, right? The volatility, we want to reduce that. But if you're currently below the realized price, if our macro picture tells us we are super, super cheap and that the next rally could be massive, then it might make sense to adjust this to 2.75x. But outside of that, yes, we are currently in a bearish trend, but we are getting closer and closer to the realized price, and historically it was best just to use the 1x, and so I continue to do that. Also, what's very important to note here is when we look at the gains that we make from the different positionings, right? When we look at leverage versus expected annual return, we make actually very little additional return with the short position, which kind of makes sense because this is Bitcoin. Bitcoin tends to go up over time, and so we are trying to make money betting on falling prices of something that tends to go up over time. So it's almost a miracle that we can make money with shorting in an asset that does multiple X returns all the time. But we do make some returns. Not massive returns, but some returns. But if we were to increase this to 2x, then our returns on average would go to 0. So then we have the odds against us. So currently we make all of this return by betting on falling prices, but that's actually not typical at all. The vast majority of gains are made on the long side. It's by making harder bets on the long side and being levered long when most people can't do this, right? If you were to go 2.7x long all the time in Bitcoin, you just have to wait until you get liquidated, right? Because Bitcoin can drop 60, 70, even 80% from the all-time high. So you cannot afford to just hold Bitcoin by close to 3x all the time. Really, what in the end this moving average strategy is doing is we get slight benefit from bear markets, we make slight profit in bear markets, but really what it enables us is that we can get levered long in a bull market without getting liquidated. That's really where the majority of gains are coming from. If we get back into a bull market and we are in it with close to 3x, then we make the real gains. Then we outperform everybody else. And most people can't do the 3x returns without getting liquidated. And by managing our risk with the moving average strategy, we can. And that's what differentiates the strategy from just random gambling. Thank you for the question. Very good question. Let me check something here. One moment. Because I've got something that is worth a like, and that's the following. I've got a comment here. I'll see this in a second. There. McDonald's is hiring fellas. So yeah, I've already prepared myself. That's like the typical thing, right? Here, Mike Saylor had this one at one time in his Twitter profile as well. When we are in a bear market, people lose all their money. People have to make money again by going to McDonald's. And so I'm prepared properly as well. But I think, yeah, the font is, unfortunately, this is mirrored. You have to read it from right to left. Still, it's important that we're all prepared for all scenarios. Hopefully McDonald's is not your plan B. Okay.
Hello from New York. Would love your thoughts on River in the near term, 1 to 2 weeks. As a long-term hold, I'm very inexperienced in futures trading and kicking myself for not opening a long a few days ago.
Don't kick yourself. River is another very illiquid token, just like Pepe. It currently rallies because of short squeezes. You do not want to be long-term exposed to those kind of assets anyways. If you want to short-term trade with it, feel free to do so, but it's a play against the other market makers. So you have very strong competition. You say you're inexperienced with futures, you're new to crypto potentially. Just stay away. That would be my advice. I love the voices.
Yeah, I think the banana voice here is the best. It's probably the best.
But I've got a few of them here. I've got a few.
This voice, by the way, is from the Saw movie, right? So I've got a game to play.
There's a few interesting ones. I can also change the voices from stream to stream. We can't be always too serious, right? It's important to be serious when it comes to investing, when it comes to money, but we have to keep it entertaining as well. Let me increase this a bit.
Beyond Bitcoin and Ethereum, would you consider an infrastructure play to position for stablecoin adoption, perhaps Circle and Chainlink?
Now, Circle is a stock, right? Chainlink is a token. With stocks in general, I try to simply diversify from my crypto exposure. I already have a lot of crypto exposure, be it long or short, because that's my main market, because I think I have an edge in there. At least the 5 years tell me that I had. And so I don't buy stocks that are close to crypto. I just buy stocks in order to diversify away from crypto. And that's mainly just QQQ and VOO, right? So Nasdaq 100 and S&P 500 ETF. For Chainlink, again, if you look at Bitcoin relative to Chainlink, unfortunately, Chainlink long-term tends to underperform after an initial wave of adoption. And that's because the team has to always dilute the supply, right? The team has to cash out in order to fund the operations. And very often those operations don't create enough value to justify the dilution. And that's why we see Link relative to Bitcoin going down. Let me show you what I mean. So let's just go to TradingView and let me show you how I do this. So I enter something like Link USDT relative to Bitcoin USDT, right? So /, and then I press enter, and then I get the long-term chart. Then we zoom out a little bit and we get this here, right? So Link relative to Bitcoin peaked in August of 2020 and since then underperformed by 92%. And since launch, it also slightly underperformed, right? Not much, but it just went basically in line with Bitcoin. And so the question is really, does it make sense to take on this additional idiosyncratic risk of buying an individual altcoin when it performs as good as Bitcoin, potentially worse as Bitcoin? When we can get Bitcoin's performance just by buying Bitcoin itself, or buying the least risky of the cryptocurrencies, why would we buy Chainlink? Now, there is an idea to potentially buy bottoms when we are very, very low, and then maybe bet on a subsequent rally. How do those rallies in Chainlink get created? It's mainly announcements, right? So if the team has built a certain technology and is then announcing that new technology, that announcement creates a lot of excitement and that creates those rallies. And very often the rallies are then cascading in a way that we see short squeezes. This can happen again. So what I believe is going on here with Chainlink is that the team is developing something, it's announcing it, the price is going up, and then the team at those inflated prices will then dilute the ownership, will then issue new tokens and sell the new tokens at those elevated prices. They sell and sell and sell, they develop until they've got something new that they announce, and then the Link price relative to Bitcoin again doubles, and then it sells again. And so yes, right now the valuation isn't too bad relative to Bitcoin. You could, in theory, just buy now and hope for the next announcement. I'm personally not doing it. It might make sense to buy after we fall in a bit more, but those kind of charts, they also, right, this is like another 20%. They also look very optimistic, but it's very possible that we lose another 20% and then we just hope for the next announcement. The best, of course, is if you know the developers at Chainlink very closely, if you make them your friends and you get an idea of when they might announce something again. So if you have knowledge ahead of time, right? If you know this better than the average market participant, of course, it's great to trade. Buying and holding Link just over Bitcoin, I think, is a mistake, right? We always want to own things that long-term is the best asset within an asset class. And we do not diversify by buying different things within an asset class. We diversify by buying different asset classes. So what I mean by this is we don't want to buy 10 different altcoins to be diversified from Bitcoin. When you want to diversify from Bitcoin, instead we should buy, say, precious metals or property or maybe stocks. But we don't diversify by buying the same thing in the same asset class. If we buy 100 different stocks, we are not diversified. We are diversified if we buy, say, one stock and one cryptocurrency and one precious metal. We want to diversify, right? We want to reduce our risk of a portfolio by buying things that are not correlated. And on that topic, I want to show something new. Have a look at this. This is something that I just set up. It's an overhead camera, but I think it's not moving right now, unfortunately. Let me see if I can make this work again. I got this nice overhead camera set up and I think it has an issue of running right now. That's a shame. That's a shame. Camlink 4K, does it work? Nope, it does not work. That's a shame. Okay, so I have this camera here that is not right, an overhead camera and a little thingy to write on. And I even had prepared a few pens and I wanted to show you this concept of proper diversification across asset classes, but not today. My camera doesn't work. That's the issue with... Oh, wait. We got it. Nice. Okay, it does work. Okay, never give up too early. Okay, so here is what I mean. Let's get this properly done. Here's what I mean. So let's say you've got Bitcoin. Let's make Bitcoin in blue. Okay, and Bitcoin every now and then rallies, then crashes down, then it rallies again, it crashes down, it rallies again. And people might just say, okay, just buy and hold, right? Or sometimes maybe try to sell when we have, try to buy when we have crashed enough from the all-time high, right? These kind of drops, they tend to be somewhere between 70 to 90%. Right, so once we are in this kind of range, when we go closer to the 70%, just buy a bit more over here, and that's it. When we hit new all-time highs, maybe sell a bit over here, right? So that's fundamentally how we want to ride the waves. The issue, unfortunately, is that it's very hard to always sell a lot at the top because the amounts that we own over here are so high that we suddenly have to move a lot of capital, right? So from the bottom here to the top here, we can easily make, say, a 5x. And let's say you're buying in regularly on the way down, you're buying in, say, $1,000, and you do this, say, over a year, you've got 12K. So you're used to buying for $1,000, you've got 12K at the bottom invested. And then you make a 5x. Now you're at 60K over here. When you're at 60K, very often these elevated prices, they happen only for a very brief period of time. Like we tend to crash quite quickly, right? We appreciate slowly, we crash quickly. We are at elevated price for a short time. So we have to sell much more aggressively over here than we were buying over here. We were buying just for, say, $1,000 every now and then. But if we want to exit, we have to exit not over the course of 1 year, but maybe over the course of just a few weeks. And so then we suddenly have to move, say, with a single transaction, $10,000 or $20,000 or maybe $30,000, right? The more aggressive we want to be on reallocating again. So it's very hard to sell the top because the amounts that are involved are much, much higher compared to the amounts involved when we buy. And so that's why many people are actually successful at buying. Many people are right to buy low. Many people are okay to do this, but the vast majority of people are not able to take profit early enough. Most people get wrecked and they're not selling the top. It's psychologically extremely hard to do this. What I do in order to make this psychologically a bit easier is I want to own other things as well. And what's important here is not to own other things in crypto. Because the problem is crypto is highly correlated. So let's say you don't just own Bitcoin, but you also own Solana. And Solana moves maybe like this. Right? It kind of moves the same, not always, but it kind of moves the same. And then you also own Ethereum. Ethereum also kind of moves the same. And so you try to diversify, owning those different asset classes, or rather owning those different assets within an asset class. But really, are you diversifying? You're not diversifying, right? Things go up and down at similar points in time. Instead, what we want to have is we want to buy something that does not move in the same direction at the same time, that is not correlated. So let's say we've got gold, okay? Let's say red now is gold. And gold suddenly goes down when crypto is appreciating. And then when crypto is crashing, when maybe the world is burning, when everybody is bearish, when risk-on assets sell off, gold tends to go up. And then when there's a rally again, it tends to go down. Then when there's a bear market, it tends to go up. This is of course the ideal scenario, right? We don't know. Sometimes both might go up at the same time, both might go down at the same time, but you know what I mean, right? So in general, gold might not appreciate as quickly long-term as crypto does, but it tends to move in opposite directions. When we now have a portfolio that's combined of, say, the dark blue line, right, Bitcoin, and gold, the red line. If we now combine this, and that's the important thing, both of those assets tend to appreciate over the long term, and most assets do because of monetary debasement, right? The 6.8% of new dollars that get printed all the time. If we now combine the red and the blue line, we might have a portfolio that looks like that, right? I'm just trying to find a line that goes through those two. Something like this. What is great about this black line? I hope you can see this black line over here. The nice thing about it is that we have removed the majority of those down movements. We have one over here, right, where both assets went down at the same time. But in general, right, especially if they are negatively correlated, meaning one goes up while the other one goes down, we have suddenly reduced the overall risk of our portfolio. We have similar kinds of return. We've got the return that's a combination of both of those assets, but the volatility, the ups and downs of our portfolio is much, much lower. Why is this good? First of all, having more return for less price risk is good, but it's also good because it helps us buying the bottoms and selling the tops more. Because this is the main thing most people misunderstand. Most people think that diversification is only a risk mitigation strategy. And if I want to make maximum money, I should rather not diversify, because then I don't own 100% of the thing that goes up the most. But that's actually wrong thinking, because the thing that goes up the most tends to also be the most volatile. Thus, if we have a diversified portfolio, what we can do is, if one thing crashes, right? For example, over here, Bitcoin crashes. When this is happening, we can sell some of the gold that was appreciating and take that and put this into the bottom. Buy the bottom with the appreciating gold. When then Bitcoin is going up, and it's appreciating much, much quicker, now it's much easier to make the sale for the 10, 20, 30K, because then we can rebalance the portfolio and buy the gold. We sell the important thing, we sell the expensive thing, and we buy the cheap thing. So we are not deciding between bad fiat currency and great Bitcoin. We are deciding between great Bitcoin and great gold. Right? They both appreciate long term. We are just reallocating our portfolio. We have different allocations to the different assets based on what we currently think is cheap versus expensive. And there's different ways to measure different asset classes on whether they are currently cheap or expensive. Right? So for, say, Bitcoin, we might use the realized price. For gold, we might use the gold price relative to the monetary base. For, say, property, we might use the rental yields. For stocks, we might use PE ratios. So there's different things that make assets cheap or expensive. But that's the whole idea of the diversification effect, right? We want to be exposed to different kinds of risks, to different kinds of valuations, that we have independent movements, and that we can then buy the thing that's cheap and sell the thing that's expensive. Unfortunately, right now in the market that we're in, most things are expensive. And so having a high cash allocation is, I believe, okay. Yeah, if you found this useful, and if you never thought about this in that way, then if you're new here on the stream, feel free to give this a like. Let's talk about a few more charts that I have prepared. So this is Bitcoin dominance, right? This is the classical Bitcoin dominance chart that most people use. And I think it's useful, as in we can see if Bitcoin currently is comparatively expensive or comparatively cheap relative to the rest of the crypto market. So if you want to make rebalancing within crypto, this might be an interesting point to potentially determine whether or not we will hit altcoin season at any point in time. Now, this is Bitcoin. We can Let me see if that's the next thing. Yeah, we can actually adjust this. So this is Bitcoin dominance excluding the stable coins. So we're looking at Bitcoin's market cap, BTC, / total ES. ES stands for excluding stable coins. Why is this even more interesting, this chart? It shows us the current appreciation of Bitcoin in a more constant trend compared to the Bitcoin dominance chart. Right here we have this line, but the Bitcoin dominance chart excluding stablecoins seems to be longer in duration. It seems to show the trend a bit cleaner. It also shows us, unfortunately, a top that might be reached a bit earlier compared to the dominance chart. Right? The dominance chart might imply that Bitcoin has the chance of potentially outperforming the rest of the market by another 25%. If we exclude the stablecoins from that view, it's only 12%. So maybe we see history repeating itself to a degree again, right? Maybe the thing that happened in 2019 will repeat. We first sell off from potential peak, go down, and then hit that peak again. And so maybe, right, we shouldn't wait all the way until we had 75% in adjusted stablecoin dominance. Maybe we should already sell once we hit the 71%, 72% over here. So that's, I think, another interesting way to look at current dominance charts. We don't necessarily have to take it to the bank just because this particular dominance chart says we can go to 73% without stablecoins, that there's still 25% potential outperformance. Maybe the outperformance is less, and maybe we have to be a bit more cautious with using only Bitcoin as a hedge for our trades. So yeah, that's very important. What we've got here at the bottom, that's the Bitcoin price. Again, I do not expect the altcoin season to hit anytime soon, because in the past, altcoin season only came about when Bitcoin has just hit new all-time highs, right? When we are already in a rally, then there was a rotation towards more risk on assets, and I believe history will repeat itself. So as long as we are in a bear market, Bitcoin's dominance will likely continue to rise. That's my base case. That's how I'm personally set up. Here's Ethereum relative to Bitcoin. It continues to underperform, and I bet on falling prices of ETH. But as said, right, if Ethereum suddenly is going to go above its best moving average, right, if it's going to cross that 34-day simple moving average, I might close the short position on Ethereum as well. But as long as we stay below the moving average, I feel very comfortable shorting ETH relative to Bitcoin and continue to bet on falling prices. There is quite a bit of potential gain to be made here, right? If Ethereum hits its support again, it could potentially fall another 9% or so. And yeah, I'm currently still positioned in that direction. Here's the Ethereum dominance chart. There's quite a bit of way to go further down. We all know why it went up first, right? It was Tom Lee by Bitmine, right? An Ethereum treasury company that was buying a lot of ETH. But that purchase, those kind of purchases are slowing down. When you look at the Ethereum that's stacked by those different ETH holding companies, so there's quite a few of those companies actually, it does look positive. It does look like Ethereum is getting bought more and more. The issue is that the rate of purchases is slowing down. And the second issue is that the source of the purchases is getting more and more concentrated. Because when we remove Bitmine from that chart, then that's actually what's going on. So without Tom Lee's Bitmine, and Bitmine is slowing down purchases, if you look at all other companies buying Bitcoin, there's no more purchases since the beginning of September of last year. And so that's why Ethereum had such a hard time outperforming since September of last year. Right? Ethereum isn't getting bought anymore by the treasury companies, and that's why it's doing worse. And only Tom Lee cannot support Ethereum's price enough, and Tom Lee is also purchasing at slower rates. And so that's still my base case for Ethereum. Ethereum is likely going to do worse than Bitcoin. But again, I'm open to potentially reduce or completely close that position if the Ethereum best moving average suddenly turns bullish. Because again, on the US dollar chart, it does look like Ethereum is not that expensive right now. We've got our nice supports. The question is really who's going to buy it. And probably the main purchasers of Ethereum at those low prices would just be speculative capital. So maybe some people that use perpetual futures to use some leverage on Ethereum. Maybe some people that might be picking up the lows that are buying now anyways for many, many years. But the attention on crypto is still so low that I'm not sure whether or not this will be sufficient demand. But still, TA-wise, right, in terms of technical analysis, just looking at this chart, this is of course very, very attractive. Let's have a look at a few more questions.
I make 1% per day collecting fees.
Congratulations to you. I think this is either very risky or not sustainable. But I personally make alpha of a bit over 2% per month over buying and holding Bitcoin. So 1% per day is very much out of the ordinary. It's also a weekend. It's likely if tomorrow stocks drop heavily and gold rises, Bitcoin will fall, in my humble opinion. Yes, there is some correlation between the stock market and Bitcoin, but we have futures markets on traditional finance as well, right? And they did not drop much. So it would be surprising if when the market opens that suddenly we see the big reaction.
Yeah, do you have an edge in each of the asset classes in which you are invested?
The answer is no, I do not. I have an edge in crypto, that's pretty clear. I can also show my data, maybe in the next live stream I can prepare this. But yeah, I outperform buying and holding Bitcoin quite consistently over the last 5 years. It has even accelerated in the last few months because with the crash we made some money. But I do not try to beat every asset class. I try to just be invested in every asset class to take advantage of this diversification effect here, right? I want to be invested in different things that I can rebalance portfolio weights, that I can buy crypto very cheap when I do see it as cheap. But having an edge in the market, I believe, means that you can beat the benchmark, that you are top of market participants, ideally top 10%, maybe even better than that. The higher you are, right, in the pecking order, the more you make. So I don't try to beat other asset classes because I don't think that if I do part-time precious metals trading, that I will be better than the person that does it full-time. And so it's the same, let's say, in business, right? If you have 10 different businesses, it's unlikely that any of those businesses will take off. It makes sense that even if it's like after a while, right? If you make business A, business B, business C, if you try different business models, that you at some point focus on one business model and make this thing compound and get better over time. The compounding will probably be much stronger compared to having the attention split across different businesses. And it's the same with trading, right? If we have an edge, it's very competitive. We want to have our edge specialized in one market because that's then where we can get the real outperformance, where then our alpha is strong enough relative to buying and holding, where it's actually worth it. And yeah, owning other asset classes makes sense. For diversification, trying to beat other asset classes, I think, is hard. Like, it's better just to focus on one asset class and pull out most value as possible. Very good question. I think this is something that most people do wrong. Most people, unfortunately, do not focus on one market, and they try to trade everything, and in the end they don't beat any market. Okay.
Do low-cap altcoin fundamentals still matter? I'm looking at a low-cap in Solana that is currently working in testnet. You can apparently deploy perpetual futures market for any Solana token.
I think the correlation within a market is too strong. I don't think that a particular asset just measured in US dollars will outperform if the market itself is going down. Could there be some short-term excitement around something? Yes, potentially. Could it potentially reach a cascading effect of shorts getting liquidated? Maybe the token went down over the last months and people were betting on falling prices. Could we see a liquidation of shorts and thus even a reinforced bull? Potentially, but I think the odds are against us. And so that's fundamentally what I always think about. I want to have the odds in my favor. Every trade is just a game of probabilities. And I want to estimate what are the kinds of probabilities. If I look at the altcoin
market, when I look at say,
let's keep my voice here. When I look at this here, right? The performance of the smaller altcoins in the last month, everything went down, almost everything, right? We've got Boson that went up. If you look at the last year, pretty much everything went down except GP and Aura. If we look at even more tokens, let's say we look at all the tokens that are listed on Binance. Check this out. This is the performance of the altcoins, of all the altcoins that are listed on Binance. And what are your odds here to make money analyzing fundamentals of small altcoins? The odds are incredibly against you. And even the things that are going up, they don't necessarily need to go up because of fundamentals. This year, for example, that's just PEXG, that's just a gold token. We've got sometimes these rallies just because of short squeezes, but often enough, those short squeezes also deflate in the course of 1 year. So really, do you want to find the 1 or 2 winners to make 400 or 500% in the best case? And are you okay with potentially instead buying other tokens that are going down 90%, 80%, 70%? If you've got a diversified portfolio here, right? If you've got a portfolio of say 5 altcoins where you made your analysis on and you think they all have great fundamentals, you buy 5 altcoins, you're not going to pick the 5 winners, right? You might be able to pick one of the winners. If you pick one of the winners and 4 of them are losers, and then you're already way above what the odds here are giving us. But let's say you picked Zcash, right? You made your 5x on one investment, but you lost 90%, almost everything on your other 4 investments. Your portfolio is flat. You didn't make anything. Your portfolio is flat. You already beat the odds massively by picking one winner out of the sea of losers, and still, just by diversifying with 5 different assets, which is not much diversification at all, still you would just be break even. And so that's why taking care of the general market structure is so important. Figuring out what the market structure is doing. Why should we try to play a game that's against us? Why don't we do the exact opposite? If the vast majority of altcoins underperforms Bitcoin, why don't we just bet on those tokens going down? And we know the reason why they underperform. It's not just because sentiment is bad. It's because the early investors, the venture capitalists, they sell. It's because the team sells. It's because users of the platform itself might also sell the token, right? If you use a platform and the platform has an incentive program and gives you certain tokens in order to use the decentralized finance application, if you get new tokens and you sell those tokens, at some point you take profit. That also is selling pressure. That's also increasing supply. So everybody gets new supply, and so the token tends to underperform. And it's not just theory. We also see this in practice. So that's how I think about this. Don't overcomplicate things. Make things running in your favor. That's my big message here that you will probably not hear on many other channels. But yeah, thank you for the question. So here's a message by Kahawai77.
I like it to be not too serious. Ha 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 ha.
Okay, hope that was good enough. Yeah, let's see what other voices I can add next time. Let's see what else we have here.
Very well explained. I got it.
Thank you, Philanthropy. I'll try to use this overhead camera a bit more often. I think it's a nice addition to the set.
What's up, God?
What's up, DBO? Let me see. Okay. This is very interesting. I sometimes have these technical issues where suddenly, for example, scrolling doesn't work. Got this right now. If you've ever been live streaming and you suddenly experience those issues, let me know. What is that? Insane voice. Yeah, so I've got a few voices, right? So
Here's Banana.
This is an old man.
This is a very deep voice.
this is a radio voice, like in a video game.
This is some kind of magician.
This is the sour and scary voice.
Here we've got a woman,
You're from an older woman.
a younger woman, quite old woman.
And this is the narrator, so an old man.
Yeah, and I think that's it. That's all the voices I currently have, but I can change them. Okay, I think we've answered most important questions. I want to talk about one more thing. So we've already talked about Ethereum potentially. We've already talked about Ethereum potentially being overvalued relative to Bitcoin because it doesn't have enough purchases by the treasury companies. The whole treasury company story collapsed. So there's a good chance that Ethereum underperforms Bitcoin, even though that's a somewhat risky bet because Ethereum is very close to its best moving average, right? So we have to take this with a grain of salt. We have to manage our risk. There is a potential support here as well. That being said, when we look at Ethereum relative to the smaller altcoins, this is a very long-term chart. This starts in 2018 when we entered this trading range. It does appear as if Ethereum is still comparatively expensive relative to the smaller altcoins. So we have seen sell-offs at the current price level several times in the past. And so I don't think that Ethereum should necessarily be bought in isolation. If Ethereum suddenly goes above its best moving average, it probably makes sense to still have this hedged somewhat, because relative to the altcoins, it still seems to be expensive. When we take just the trading range when it was established, right? We take this data set over here, and we take the average price since the trading range got established. We can see how we are already slightly below the potential equilibrium. But we can also see how very often we overshot the equilibrium. And so this arrow here was actually drawn when we were at this level here, right? I didn't draw this yesterday. This was drawn at the beginning of the year, roughly. When you look at prior Ethereum videos on this channel, it was quite clear that Ethereum had some selling pressure ahead of it. I think there is a good chance that Ethereum will continue on its way down, simply because of momentum. We are already comparatively cheap if we just look at the equilibrium, but we tend to just move in this to those extremes over time. So the market tends to overshoot. So the picture is very ambiguous. It's important to just be very quickly reactive to whatever currently happens with ETH. This current bear market, right, the sell-off that happened since we hit the 126K, I believe that was the top, is actually not triggered anymore by the long-term holders. This is the value days destroyed, so this shows what the dormant Bitcoin is doing. The dormant Bitcoin is currently not getting sold off. When we look at the long-term holder spending chart, that's also currently positive, as in there's actually long-term holders that are buying at the moment. They're not buying as aggressively as they did in prior dips, but some long-term holders are currently buying. Long-term holders here being defined as wallets that have held Bitcoin for at least half a year. So what's causing then the selling, right? There's still negative realized cap change. So the realized price is going down. In other words, there is a loss realization in this current market. It's not the long-term holders potentially, right? There is one explanation, and that's the miners. So interestingly enough, the mining hash rate did take quite a bit of a dip. So what could have happened here is that some miners just shut off their mining rigs to mine Bitcoin or to mine crypto in general, And they might have moved it over to artificial intelligence, or they might have thrown out all of their ASIC miners and replaced them with AI miners. So we still have all the infrastructure of the warehouse, we still have all the cooling, we just replace the hardware, we exit Bitcoin as a whole. That's then when the difficulty is going down, right? When the price is too low, then it might not be profitable for many miners to continue running their rigs, because many miners also have positive energy costs. And if the energy costs don't get covered, then the rigs simply get turned off. And it might have been just a minor capitulation that's causing the current selling pressure. The issue really is that traditional finance is very expensive, right? The Shiller PE ratio, the price to earnings ratio of stocks, is extremely high. This chart is very long term, right? It starts in 1871, so 150 years of data roughly. This here is the .com bubble burst, right? This is where .com crashed. This here is when the global financial crisis hit. Bitcoin was created at the beginning of 2009. Bitcoin has never really seen a real crash. We are now close to the all-time high in terms of valuations for stocks. When we look at the valuation of stocks relative to the monetary base, that's also very, very high. This year is when Bitcoin was created. So really, we never really know what's going to happen if suddenly we see a crash in traditional finance. Probably it will get amplified in Bitcoin. If we suddenly saw another global financial crisis, right, the S&P 500 suddenly losing versus the monetary base by close to 60%, then probably Bitcoin will not just go down by 60%, probably it will go down by 80, 90, maybe even more than 90%. So much more than what we currently anticipate. Imagine that, right? A drop of 90% from the all-time high. That would mean a Bitcoin price of, say, $15,000. Most people don't have that on their radar. Most people think that we have to bottom out at 40 or at 30K. But if traditional finance was to suddenly crash, that would be very, very different, right? Bitcoin would crash with it, but gold might appreciate with it. So it's important, again, to be diversified, to be flexible in our allocations. This is the Nasdaq 100 relative to the S&P 500. It's also close to all-time highs. It hasn't appreciated as quickly compared to the .com bubble, and we might argue that in general tech stocks tend to just outperform long-term, and this is just in line with its general appreciation. That's a potential argument, but also, again, the Shiller PE ratio is currently close to all-time highs. The S&P 500 is close to all-time highs relative to the monetary base, and then technology stocks are simply an additional layer of risk on top of that. Let's have a look at traditional finance a bit more. Even though, again, I don't trade traditional finance assets that actively, it's always interesting to just have a feeling of what's currently appreciating versus not. And we've already seen how tech stocks are very expensive within the stock market. Let's just have a look at the top tech stocks. So let's have a look at Nvidia, Apple, Microsoft, Amazon, and Google. And again, we don't look at this in US dollars. We look at this relative to a benchmark. This is the Nvidia relative to QQQ, so relative to a Nasdaq 100 ETF. It did make sense to buy Nvidia as an idiosyncratic risk, as in it did outperform the benchmark. However, the outperformance is slowing down quite a bit over the last 1.5 years, roughly. Since June, since June of 2024, Nvidia has not done better than the Nasdaq 100. So the additional risk that we got with all of those AI investments so far did not pan out. It did not bring more performance to Nvidia. Isn't that interesting, right? We've got all of those new spending commitments, all of this new hardware purchases, yet in the last 1.5 years, we didn't see that much more outperformance. This is Apple relative to the Nasdaq 100. It also long-term tends to outperform, but the outperformance has slowed down quite a bit as well. So over the last 14 years, roughly, it outperformed by only 21% versus the Nasdaq 100. Right? So you got roughly 1 percentage point, a bit more than that, 1 to 2 percentage points per year additional performance by buying Apple over the Nasdaq 100. So is it worth the risk? You have to decide. This is Microsoft relative to the Nasdaq 100, and it has not seen any outperformance for the last 30 years. roughly. Isn't that interesting, right? So if we take the Nasdaq 100 as a benchmark to Microsoft, Microsoft's rally is non-existent. There was all this outperformance up until the dot-com boom. With the dot-com boom, Microsoft got also sold off a bit more. But really, after dot-com, Microsoft did not do better than the rest of the tech market. Does it make sense to buy Microsoft versus just QQQ? It's your thing to answer, right? But it probably might make sense to buy it when it's very cheap, if you're bullish on it and if you know that Microsoft has some tricks up its sleeve and that it will potentially turn around. But if you're just buying in order to diversify, diversification within an asset class is always not that useful, right? So that's the idea that I try to convey over here, right? If we buy the same kinds of assets, and again, my webcam here died, unfortunately, it's just a still picture. If we buy different assets within an asset class, right? So say Solana and Ethereum, besides Bitcoin, we don't really gain much in diversification. But if we buy across asset classes, we do gain diversification. And so if you buy Microsoft to diversify within the tech sector, you're probably not reaching much of a risk mitigation benefit. This is Amazon relative to the Nasdaq 100. Here, the outperformance has stopped in the last 9 years, roughly 9 to 10 years. Right? Since then, Amazon did not do better than the Nasdaq 100. And here is Google. So Google is the only real outperformer. Google is doing very well. And I think the reason for that is that it has been able to turn things around for AI adoption. So Google is currently stealing market share from ChatGPT. Gemini is indeed the better system, right? When I look at the thumbnail that I created for the stream here, it was created with Google Gemini with Banana Pro 3. So Google does have the superior AI. It's probably going to win the AI race. And that's maybe why the stock is doing better. Does it make sense to buy the stock now at those elevated prices after it has already outperformed the Nasdaq 100 by 70%? I don't know. Maybe, maybe not. Technical analysis can draw all kinds of fancy lines. It can tell all kinds of potentially scary stories. But again, I do not have an edge in traditional finance. I still find it interesting, though, to look at those kind of charts to see what's going on, who's benefiting currently and who's not benefiting. Okay, let's see if we've got a few more questions. We are getting close to the end of this stream. So yeah, we've just answered the question regarding NVIDIA, right? The idiosyncratic movements of NVIDIA are close to zero because it just moves with the general Nasdaq 100 market.
Are you considering more exposition in Swiss franc, considering that this currency is overperforming US dollars and euros in the last 5 to 6 years?
Again, I haven't looked at fiat currencies too much. What's important here is not just to look at the valuation of the Swiss franc, it's also important to look at the return that we get. So if the Swiss franc appreciated over the last 5 to 6 years, was the interest rate that we got on the Swiss franc on average also lower? And by how much? And how much after considering the interest rates did we actually outperform using the Swiss franc? Very often getting in and out of those positions, swapping the currencies, etc., as a retail investor isn't really worth the diversification benefit, isn't really worth the potential appreciation that we can get. So I just stick with the US dollar for now for my fiat exposure, and there might be 1 or 2 percentage points in diversifying across different fiat currencies. But what is 1 or 2 percentage points, right? It's not really major. I think it's much easier to gain an additional 1 or 2 percentage points in crypto if you just get a bit deeper in that. But if you're already in Switzerland anyways, and this is your main currency, you might as well have some good allocation towards the Swiss franc. Among the fiat currencies, the Swiss franc is definitely considered to be one of the better ones.
What do you pay attention to in situations like this, where war may break out and we don't know when it will end?
Yeah, so I try not to pay too much attention to it. I still follow the news. I watch the developments, maybe like 15, 30 minutes a day. I look at what has changed. I do check them, but I don't trade based on them. I simply just want to know what's going on, but I'm not going to change my positioning in relative valuations or in crypto based on that. I'm also not changing my diversification bet on stocks based on that. But of course, it's just another reminder that war and potentially disruption of supply chains, potential trade wars, etc., are risks that are always hovering and that we should diversify for, right? Having some gold always does make sense. But of course, we don't want that gold actually to go up because it's an insurance, right? It's like a life policy. We buy the life policy, but we don't want to ever get paid for that life policy. That's how I fundamentally think about this. XRP Goat says,
Hi there, I've been watching your notes recently. You're one of the few I give my time. Respect to you, sir.
Thank you very much appreciated. I try to provide as much value as possible. Of course, in a stream like this, it's less value dense per minute, but it's also a bit more personal. That's what I like. I like to give a lot of value as much as possible while still being close to the community. Okay, I think that should be it for today. Thanks again for watching. Thank you very much for all the questions, for all the comments, for all the thumbs up. If you haven't yet subscribed, then of course feel free to do so as well. I think the vast majority that's watching here is already subscribed. But thanks again for being part of this stream. I will again get a few clips cut out of the stream that will be published over the course of the next few days. So if you haven't watched from the very beginning, feel free to simply check out those clips. They will be They will be marked with highlights, right? So there will be the title of the video, and then there will be highlights behind this as an indicator that this comes out of the stream. So we will get those kind of publishings. We will also have then new videos, right? Every now and then I publish videos. There's also the one-on-one talks. So be prepared for 2 to 3 videos every single day. Feel free to watch whatever you enjoy. Feel free to also, again, join Premium in case you haven't done this yet, to get my personal trades, to also get more fundamentals, right? Things like this. There's a lot of tutorial videos that are hopefully very valuable to you if you've got some wealth to manage. You don't just have a few months, but potentially even a few years of your income saved up already. Then that kind of knowledge is probably going to be worth it. So feel free to check out Premium, and thanks again for watching. See you next time. And yeah, see you next time. Cheers. Bye-bye.